This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
We're now in Chapter 20. Look, as we did back in Chapter 12 for CGT for individuals, at specific issues, further aspects dealing with the capital gains calculations. And most of this certainly will be revision so far as you are concerned. If you look back at Chapter 12, and it's something I'd quite like you to do now, so if you haven't been revising Chapter 12 of late, I would like you to look back and look at these areas: part disposals, chattels, and non-chattel wasting assets. What were the issues? When dealing with part disposals, we saw that we were selling a part but not all of an asset. Therefore, how did we establish the cost of that part of the asset when sold? We know how much you're selling it for, like we've always seen recently with shares. If there's any problem calculating any part of the gains calculation, it's about cost. So with part disposals, we have a method of computing how much of the original allowable cost of the entire asset belonged to the part being disposed of, and it required us to apply a fraction to that original total cost, a fraction that was based on top line sales proceeds over bottom line sales proceeds plus value remaining. Go back again to Chapter 12 and revise what we did there. For the only new thing then that we have to deal with, which we'll see once you've done that revision, now in example 1 here below, we'll see that the only new aspect is, if it's a corporate disposal, then having established what that allowable cost figure is, then indexation allowance is available on that cost. Now, as long as you know how to do your basic gain calculation with your part disposal working in there, all this involves is, and now let's apply indexation allowance to that allowable cost to get a lower figure of gain. It's one new element, it's just indexation. Same with chattels. When looking at chattels, we learned rules as regards wasting chattels, what would be exempt, so no calculation to do, just wasting chattels were exempt, and then other tangible chattels that we would deal with. Tangible chattels that were not wasting chattels, things like antiques, paintings, jewellery, stuff like that, that when disposed of there were special rules. Now those rules, again, you need to re-familiarise yourself with back in Chapter 12, and they included: if you buy and sell a chattel for less than £6,000, it is exempt. If you buy for less than 6 and sell for more, there's a maximum gain calculation to limit any actual gain that may have arisen. And when dealing with a chattels disposed of at a loss, then if bought for more than 6 and sold for less than 6, you merely deem the gross proceeds to be £6,000. Now, if we are dealing with any gains calculations here, then all we've got to remember is, on a gain, having established allowable cost, indexation. So again, the only difference in dealing with part disposals or chattel disposals for companies as compared to individuals is, where applicable, where there's an allowable cost and we're not looking at a loss situation arising, indexation allowance is now available to further reduce the gain. This is not tricky. Then again, when dealing with non-chattel wasting assets, again covered within Chapter 12, an example there dealing with the copyright, the only new thing coming in terms of corporate tax is indexation allowance. So this should be a very easy section, doing the things that we did for individuals, but where applicable, where there are gains otherwise arising, then applying an indexation factor to an allowable cost and deducting the indexation allowance. Only after we've gone back through those things will we then go on to a relatively new area, which we've chosen here to illustrate in the context of companies, which is dealing with the damaged assets or assets lost or destroyed. That's in the second half of this chapter. So prior to that, go back please to Chapter 12 as referenced in here, dealing with individuals. Look at the rules for part disposals, for chattels and non-chattel wasting assets. Non-chattel wasting assets there, easy for me to say. And we will then go through the examples that exist here in dealing with corporate tax. As I say, The new bit is just putting in a bit of indexation. That shouldn't be tricky. Okay then, first of those areas, hopefully now you've revised through part disposals. Let's see our example number 1 to illustrate. Calculate the chargeable gain on the disposal of the 2 hectares of land in October 15. Yeah, if you're going to deal with a part disposal, the most likely asset to be dealing with, certainly in the context of a corporate disposal, is land owned by the company, where some but not all of the land owned is now disposed of. Problem again, as it always is with a part disposal, is how do you work out the allowable cost for the part now sold? Right, what are we told? This time ST Limited owned 10 hectares of land which originally cost £26,000. And that was back in March 2011, and of course we're told what the then RPI was. What's happening now in relation to the disposal in October 2015? Sold, as the question tells us, 2 hectares of land for £16,000. The remaining 8 hectares were valued at £34,000 at that point in time. The value remaining. So how do we do it? Pick up our sales proceeds. What are we now selling this 2 hectares of land for? Sold the 2 hectares of land for £16,000. Sales proceeds, 16,000. We now need to know the allowable cost. So what was the original cost that we incurred when buying all of the 10 hectares? That was a cost of 26,000. How much of that now belongs to the part being disposed of? Remember the basis of the calculation. Sale proceeds, 16,000, over sale proceeds, 16,000, plus the value remaining. That's 8 hectares, which were valued at 34,000. So, sale proceeds over sale proceeds plus value remaining. Multiply out by your original total cost, that was 26,000, and all being well, that gives us an allowable cost, which I made to be £8,320. Take it away, and we have got now not the gain, but the unindexed gain. £7,680 worth of unindexed gain, from which we need to deduct indexation allowance. So what was the allowable cost? The allowable cost, 8,320 times the indexation factor. Now you again should be able to do that now. If not, again, we got ourselves a bit of a problem. Go back to the previous chapter and rework the basis of the indexation, but hopefully this is not a problem. How do we work the indexation factor? Pick up the RPI for the month of disposal, 259.5, minus the RPI for the month of acquisition, 220.7, or over the RPI for the month of acquisition, 220.7, and express to a 3 decimal place indexation factor. Now when I put that through my calculator, that rounded to 0.176. Apply that to the allowable cost, and that, all being well, gives you indexation allowance of £1,464. Again, do please check through the calculator with your own calculations there, leaving us with an eventual chargeable gain of 6,260. Everything was the same as we had done, down to what is now not the gain, but is simply the unindexed gain. Then apply, as usual, your 3 decimal place indexation factor to whatever was your allowable cost figure there. Thank you very much. Job done. Easy peasy. Right, onwards from part disposals to dealing with chattels. Chattel disposal, we're told here in note 1.2, dealt with the same way as for an individual, which I hope you have just revised. But again, all that will happen in your normal gains calculation, you've got to now bring in indexation allowance. But let's have a little look at our example 2, which, as with example 1, is a rerun of what you did for individuals, but now of course for a company, and therefore bringing in the issue of indexation allowance wherever applicable. So what have we got? JM Limited now sold the following assets in October 15. and we've got to calculate the net gains or losses arising for JM Limited in October 15. So what have we got to begin with? Antique table. Again, your typical example of a non-wasting chattel. Had cost £3,000 in February 09, sold for £5,000. What do we know about that? Well, you bought it for less than 6,000, you've sold it for less than 6,000. That therefore means that the disposal is exempt. Next one, a painting. Again, as with all of these non-wasting chattels. A painting which had cost £2,000, sold for 10,000. This time though, bought for less than 6, it's sold for more than 6. So we do have to do our gains calculation. Therefore, it is relevant to know January 2011 purchase date, October 15 disposal date. Pick up therefore from the information here about RPIs, because you will need to apply indexation in your actual gain calculation. Now remember what you do. If bought for less than but sold for more than 6,000, do an actual gains calculation. Well, that's simple enough. Sales proceeds £10,000. There. Cost £2,000. Take your cost from your proceeds of 10, 2 from 10 will be £8,000. You will then apply an indexation factor to the allowable cost of £2,000. The indexation factor again computed using the relevant RPIs, month of sale, month of the acquisition. Get a 3 decimal place indexation factor and apply it to your allowable cost. So, if not already, I would like you to do that calculation, work out what is the actual gain, and then apply the maximum gain calculation to that. If lower, we use it. If not, we will just go with the actual gain. What was the maximum gain calculation in this scenario? When bought for less than 6 and sold for more than 6, we take 5/3 as just the arbitrary fraction that we have to remember to learn and then to now apply, and multiply it by whatever is the excess of the gross proceeds, £10,000, over the £6,000 exemption limit. 10,000 minus 6 will be 4,000 times 5/3 will be the maximum gain. Compare that with your actual gain as indexed, and the lower of those two figures will be the gain to use. So if you haven't already done that, could you please have a go at that, work through, and then we'll continue it on. Okay, hopefully on the disposal of the painting therefore, you discovered an actual gain after indexation allowance of £7,618, and when you applied the maximum gain calculation, which again I trust you remember, 5/3 times, in brackets, 10,000 minus 6,000, gross proceeds minus 6,000 limit. And that little calculation, I believe, comes out to 6,667. Well, that now is less than the actual gain of 7,618. And on that basis, therefore, you apply the maximum gain. It will be £6,667. On to C, an antique vase, cost £8,000. They tell you when, August 2002, sold for £3,000. Right, this one clearly sold at a loss, but critically, bought for more than 6, sold for less than 6. What is the rule that therefore applies in this scenario? You ignore the actual proceeds of £3,000 and calculate a loss based on a deemed gross proceeds of £6,000, the chattel exemption limit. So, deemed gross proceeds, 6,000. There's no selling expenses here to deduct, but we would if we were provided with that information. And then from those net proceeds, we will deduct our allowable cost of £8,000. This therefore will be 6,000 deemed proceeds less 8,000 cost. That's a capital loss of 2,000. And that's it, capital loss 2,000. Remember that if there are losses, there is no indexation allowance. Indexation cannot serve to either increase nor create a loss. So quite simply, allowable loss £2,000. And finally on this one, well, no work to do. A vintage car. Doesn't matter whether it's vintage or otherwise. A car, a motor vehicle there, and on that basis, that will be exempt. Doesn't matter what the cost is or when you incurred it. Doesn't matter what you sold it for and when you sold it. There, the disposal of a car is exempt. So no calculations to perform. Just tell the examiner that disposal is exempt. So again, just simply applying the rules that we have previously seen. Again, if not already, work through each of those individual calculations where appropriate and compare please with the model answer. Make sure you're happy with that and then come back and we will continue with basically what is revision from what we dealt with in earlier chapters. So as we said, the next bit of revision from what we studied at CGT for individuals is dealing with the disposal of a non-chattel wasting asset. So non-chattel, chattel, tangible movable property. So this is not tangible movable property, but it's a wasting asset, i.e. a life of no more than 50 years. The example we're about to have is a life of 30. But wasting there, wasting asset, a life of 50 years or less. Non-chattel wasting asset, typical example, a copyright. Again, we use this as our example back in CGT, and we're going to use it again now. Non-chattel wasting asset disposed of by a company, same as we did for individuals, but again, with the cost going into a gains calculation anyway, we apply indexation allowance. Let's just remind ourselves of how we dealt with that in relation to the information provided here. What they have done here in relation to the sale of the copyright in October 15, they have provided us with an indexation factor of 0.486. You should know how to calculate, of course, the indexation factor, as you've now done it on many, many occasions. So what have we got? First of all, what did we sell the copyright for? There, Z Limited sold the asset for £38,000. Sales proceeds, October 15, amounted to £38,000. Away from those proceeds, obviously, if there were any selling expenses incurred, but otherwise, and hence the problem, we have to deduct cost. Now, our allowable calculation here of cost is based on what was the original cost that we had bought a copyright at a cost of £25,000. Cost £25,000. But that is not now the figure that we're able to deduct. What we've got is a wasting asset. It's a life of no more than 50 years there, and therefore we will not be allowed to deduct all of that cost. What we've got to do is to depreciate that cost. So how do we do it? We deduct from the cost figure the amount of the cost that will have been expended. That's based on a strict time basis. When we bought it, it had an estimated useful life of 30 years. We bought it on the 1st of October 03, and it was sold on the 1st of October 15. Therefore, of the 30 years of life that it had in it when we bought it, how many years have elapsed? 1st of October 03 to 1st of October 15, we've used up 12 of the 30 years. Now, there's the original cost, which this calculation is based on, but there's one other factor that's crept into this. That, at the end of the life of this asset, it's got an estimated residual value of £1,000. Therefore, instead of just being 12/15ths, instead of being just 12/30ths there, I should say, of £25,000, the original cost is 12/30th of 25,000 minus that residual value of £1,000. So, number of years from when bought to when sold, 12, out of the useful life when bought, 30, times what will be the net cost over the life of the ownership of that asset. That is 25,000 minus the £1,000 residual value. 12/30ths, therefore, of 24,025 minus 1 should come to a deduction of 9,600. That is how much of that original cost has basically wasted away at this particular point in time, thus leaving us with a net allowable cost of £15,400 that we can now deduct, not in deriving the gain, but of course in deriving for a company the unindexed gain. And that will be some £22,600, methinks. And as we kept saying on all of these issues now revisited under corporate tax, it's just a question of indexation allowance. Again, based on individual dates, you would establish for yourself, if not otherwise told, the indexation factor. We've been given that indexation factor here. The indexation factor 0.486 times, as it always is, our allowable cost. What is our allowable cost? There is computed £15,400. Multiply it through. What do we get as the allowable cost? Hopefully, if my calculations are right anyway, I got that to £7,484. Take away your indexation and you'll then have a bottom line chargeable gain here, £15,116. So again, the only new component, bringing in therefore the indexation allowance, applying as an indexation factor to whatever you have computed as the allowable cost figure. Again, please, before going any further, check that out with the answer in the back, please. We now move our attention to look at something that we have not as yet dealt with. We've made mention of the fact that assets may be damaged or, in the extreme, lost or destroyed, and therefore, if they are lost or destroyed, that would represent a chargeable disposal. Therefore, a gain or indeed a loss calculation may have to be performed. Now, we'll deal with those assets lost or destroyed separately in just a short while, but to begin with, what happens if assets are damaged? So that's the first area, damaged assets. Now, although we have not dealt with this specific area before, the technique that we're going to use in dealing with such an issue is a technique we're already fully familiar with, and that is that if an asset is damaged and, here's the important point, compensation or insurance money is received as a result, then this will normally be treated, this is the compensation or insurance money, as a part disposal of the asset. The cost is calculated using the normal part disposal formula. Now we know what that is, A over A plus B, or sales proceeds over sales proceeds plus value remaining. Now then, we've said here that if you receive money, insurance money, then we're going to have to do a part disposal calculation. But it says, if insurance money is received, then if the insurance money is not used in restoring the asset, so the asset is damaged, but it is still in working order, so you continue to use it, or use it as much as you wish to use it, then if it's not required to be repaired to carry on being used or to give value to your business, what you can do instead is just keep the money. Sort of, well, that's an unexpected little bonus, some money coming in terms of the insurance claim, but the asset may still be used. So if that insurance money is not used in restoring the asset, then you do, as we've just seen in the first part, a normal part disposal arises. So the money received, the insurance money received, is your sales proceeds, and then you do a part disposal exercise, looking at that money received, that's your proceeds. You'll be told what the asset is then worth in its damaged condition, that is the value remaining, and proceed to do your normal part disposal calculation. As we said, the market value of the part retained equaling the value of the asset in its damaged condition. All of which, of course, figures that must be provided to you. Having said that, you might think, no, I need this asset back in full working order, so what happens if the insurance money is fully used in restoring the asset. Then the taxpayer can elect to have the proceeds deducted from the cost of the asset for purposes of a future calculation of a gain. So rather than crystallizing a gain now, where you've received the insurance money and you've then used it in restoring the asset, basically you can take that insurance money away from your original cost. Now don't worry, that again would defer the initial gain at this point in time when the insurance money is received, but any money that you have then used in putting the damaged asset back into a working condition, that will now represent a further allowable cost. Let's see how that works with, as luck would have it, we have a little example here. So let's have a little read through and see what is happening, what is the scenario. Again, of course, in these notes we say this is the scenario, this is an example. The difficulty for us always in the exam room is recognizing when we read a question without a formal introduction telling us what it's all about, is to determine what is it all about. So we're told M Limited bought a painting on the 1st of April 2000, cost £10,000. The painting was damaged on the 1st of May 15. So here we go, we can now see we're dealing with a company where an asset that it owns, it happens to be a painting, was damaged there. So we know what the issue is, damaged asset. So we then want to know to see whether any insurance money is received and what did we do with it. First of all, though, they tell us that when the painting was damaged at that point, it was worth £50,000. After the damage, it was only worth £25,000. On the 1st of July 15, insurance proceeds of £30,000 were received and were not used to restore the painting. Assume an indexation factor from April 2000, note to July 2015. What happened in July 2015? That is when the insurance proceeds were received. Only at that point do you have a deemed disposal, albeit here a part disposal, that is deemed to have occurred. So the relevant date here in terms of a disposal is not when the asset itself, the painting, was damaged, that was back in May 15, but it's when was the insurance proceeds received. That is the deemed disposal date. So let's have a little look now at our calculation of the chargeable gain arising on the receipt of those insurance proceeds. So what were our proceeds? The insurance proceeds, sales proceeds here, amounted to, insurance proceeds, £30,000. So there we go, we've got our proceeds, £30,000. We've now got to calculate based on this, what would the allowable cost have been? Remember here, the proceeds of £30,000 were received and were not used to restore the painting. Therefore, we've received cash that we haven't put back in terms of repairing that asset, and therefore a disposal has occurred and a gain must be computed. But because it's not totally lost here, not totally destroyed, this is a part disposal rather than a total disposal. How do we deal with that? What was the original cost? Original cost, £10,000. 10,000 times, what was our A over A plus B calculation, times sales proceeds, 30,000 over 30,000 plus value remaining. Now this was the value of the asset in its damaged condition, in which condition we're going to leave it, because we're not going to use the insurance money to actually repair that asset there. So in its damaged condition, it was worth £25,000 plus 25. Okay, calculator time. Again, as per usual, put that through your calculator and get your allowable cost. On my workings, I got that to be £5,455. Take, of course, your allowable cost away from your deemed proceeds to get your unindexed gain. Here, £24,545. 24,545. Of course, we now need to apply indexation allowance here, and indexation allowance, what is our indexation factor? Well, they've told us through to the date that we received these proceeds, it's 0.505. 0.505. What do we apply it to? Our allowable cost. What is our allowable cost? You've just calculated it. There it is, £5,455. Multiply it through. I got that to be £2,755. Take it away, and that will give us a chargeable gain remaining, which I made £21,790. There is your bottom line chargeable gain to be shown within the corporate tax computation of A Limited for the accounting period in which that disposal arose. When is the disposal? When the proceeds, the insurance proceeds, are received. Because there they were not used to restore the painting. We did not reinvest, did not put the money back. And that means that we do have a gain that crystallises now. Part disposal calculation on original cost. Index the allowable cost. Calculate the gain accordingly. Again, as ever, please just take a moment to pause and check that out with the answer in the back, please. Okay, so in that example 4, what we saw was if the insurance money was not used to restore the asset, you took the money, that was a part disposal, calculate the gain, and the only issue to remember, as it's a corporate disposal, is give indexation allowance in relation to that allowable cost. Had you been dealing with an individual, exactly the same technique would have been used, only of course there would have been no indexation allowance when dealing with the calculation of that gain. So now we look at, so what happens if when you get the insurance money, you do use that insurance money in restoring the asset. Then what happens? The taxpayer can now elect to have the proceeds deducted from the cost of the asset for purposes of a future calculation, thereby deferring any gain when the insurance is received. So rather than taking the cash and putting it into a part disposal calculation, because you've used that cash, in restoring that asset, that means that we're able to defer any gain that would have arisen. How do we do that? We're going to reduce the original cost figure by the amount of the insurance proceeds there that we've used to reinvest there in that repair of the property. So let's have a little look at how that works in terms of a calculation, and as luck would have it, here we go, example 5. Now again, in an exam question, what we've got to do is to recognise the situation that we're dealing with and then try to remember the rule that we use to deal with that problem. So again, it's a company, Daisy Limited, purchased a painting on the 1st of April 2000 there for £10,000. The painting again was damaged on the 1st of May 15 when it was worth £50,000. After the damage, it was then worth £40,000. All again the sort of information that you'd be provided with if you actually had to do a part disposal calculation in relation to the insurance money received. We're told that we did receive insurance money, again on the 1st of July 15, insurance proceeds £8,000 were received. We've used all of the insurance proceeds then in restoring the painting. So we put all the money back. Assume Daisy Limited elects for the proceeds to be rolled over against the cost of the painting. Calculate the base cost of the painting on a future disposal. Now, we therefore have got to realise what happens in this circumstance. If we've used all of our proceeds in repairing that asset, there is no immediate gain. The effect will be felt in the future in terms of what then would be the allowable cost, because at this point in time the proceeds will be rolled over against the cost of the painting. Alright, let's see what will happen therefore. So the money was received on the 1st of July 15. As we've said, there is no chargeable gain as the company is elected to roll over those proceeds against the cost of the painting itself. So when that painting is sold, what then will be the allowable cost? Now, to begin with, we of course start off with what was the asset's original cost. The original cost, we were told, was £10,000. What do we then do? We deduct from that our insurance proceeds. Those insurance proceeds now received and used, £8,000. So that would reduce that original cost from £10,000 down to £2,000. Now, by having the lower cost when it is sold, there's a bigger gain. But there's something else we have to remember, of course. That is, although we have reduced that original cost by the insurance proceeds, we have actually spent those proceeds on putting right the asset. So in which case, therefore, in addition, those restoration costs themselves of, well, if it was exactly 8,000, then 8,000. If actually we spent 9,000, we only had proceeds of 8, but we spent 9,000, then whatever was the cost of restoration, that will be treated as a further allowable cost on the future disposal of that asset. So the original cost will have been reduced to 2,000, but you will then have a further figure of allowable cost equal to the amount that you actually spent there in restoring that asset back to its working order. So that too would be an allowable cost. If that here was exactly £8,000, the full extent of the proceeds and not a penny more, then on that basis you'd have another allowable cost of 8,000 to take account of. If you spent 9,000, then 9,000 would be the allowable cost, when again an extra 9,000, that's on top of this 2,000, but you'd have effectively like an enhancement expenditure of £9,000 to add in. Okay, again, just take a moment to read through the answer to that in the back, if you would, and we'll then move. Okay, last of the areas now to deal with, what happens if instead of damaging the asset, it is destroyed or simply lost? Now again, that destruction of the asset, loss of the asset, does represent a chargeable disposal. If the asset is a chargeable asset, the company of course is a chargeable person here, and therefore gain or loss needs to be computed. So how would we deal with that? So if an asset is destroyed or lost, and there is no compensation, no insurance money available, then your disposal consideration is nil. There's a disposal which will of course then result in a capital loss equal to the allowable cost incurred, because your disposal consideration is nothing. If there is, of course, if there is compensation, insurance money is received, then that will simply be brought into an ordinary gains calculation as your proceeds. The insurance money, that is your proceeds, and you use that in a perfectly normal gains calculation. It is as if you had sold it, that the insurance proceeds are your sales proceeds. Now, as we saw a moment ago in the previous example, the date of any disposal here is the date the insurance money is received, not when the asset was lost there or destroyed. If the insurance money is used to buy a replacement asset within 12 months, so that's your time limit in relation to what now you can do, the gain can be deferred until the new asset is sold. So rather than calculating a gain in relation to the asset disposed of based on those insurance proceeds, if you spend those proceeds in buying a replacement asset, then you're able to defer the gain until such time as the new asset is sold. Much the most likely situation, therefore, to see in an exam question is this one. If only part of the insurance money is used to buy a replacement asset. So you put most of the money back in terms of replacing the asset, but then maybe you take a little bit out. Then some of the gain will be taxed immediately, and some of the gain will be deferred. Now what you've got here is again a situation of effectively a rollover, but now instead of a full rollover, you're going to have a partial rollover. Now let's see how this works. It was also then set the scene for the next chapter that we deal with, which is what capital gains reliefs are available for companies here, which basically is going to mean what we learned about rollover relief. So let's read example 6 and see what needs to be done. The company had originally bought an asset for £23,000, acquisition date June 09, cost £23,000. Destroyed is a disposal that occurred in March 2015, but what is important is that insurance proceeds of £30,000 were then received in October 2015. So that's our deemed disposal date, when we got the proceeds received in October 15. SC Limited then spent £30,000 on a replacement asset. So we received proceeds of 34, but then we have spent just 30,000 on a replacement asset. Now, before we go through the answer to this, I would ask you just to pause at this particular point in time and just go back and remind yourself of how rollover relief worked. So back in chapter 14, CGT reliefs, one of them rollover relief, and what specifically happened when dealing with partial rollover. That's going to be an important lesson for you to learn for dealing with the next chapter, which we'll be coming on to very soon, having dealt with this particular example, but it's also something that's relevant for this example as well. So we'll be, as the old proverb says, killing two birds with one stone. It will allow us to better understand how to deal with this specific issue, but also then act as a basis for allowing us to be able to deal with the next chapter rather more easily as well. So if you could just do that, pause at this particular point in time, and then we'll come back and show the basis of our gains calculation. Okay, if you've now revised back through those issues in terms of rollover and very specifically partial rollover, we're in a position to be able to actually complete this exercise. The first part of the exercise is very simple. The insurance proceeds of £34,000 are deemed to be the disposal consideration on a deemed disposal of that asset in October 2015 when those proceeds were received. And we just show a basic standard gains calculation. We know we're deemed to solve for 34. We need to know the cost, bought the asset for 23,000 in June 09, take the costs from the proceeds, get the unindexed gain. Then the indexation allowance. We know that to the allowable cost incurred of 23,000, we will apply the relevant indexation factor. There's the RPI now at the month of disposal, minus what it was in the month of acquisition, all over what it was in the month of acquisition, taken to 3 decimal places. Apply it to your allowable cost, then get the chargeable gain. Now that, I said, was the easy bit, as it were. I'd like you again to pause at this particular point and work out that figure of gain prior to any rollover relief applying, and we will show that final little bit together. Okay, well, the basic calculation of the gain, therefore, I hope was straightforward enough for you. The proceeds, the insurance proceeds there, 34,000, the allowable cost 23, get the unindexed gain accordingly. From which unindexed gain we deduct the allowable indexation allowance. Now we know that that will be based on the allowable cost of 23,000. We simply use the RPIs provided to establish an indexation factor, which, all being well, if I've done it right anyway, is 0.197. Times 23,000 is our indexation allowance of 4531. Take it away, we have to begin with at that point a chargeable gain of 6469 that will then be subject to a possible deduction in relation to a rollover relief claim by the client, by the company there. Now that's available because we've actually used some but not all of the proceeds here to buy a replacement asset. Now had we reinvested all of the proceeds of 34,000 in buying a replacement asset, then the rollover relief would have been the full extent of that chargeable gain of 6469, and nothing would have remained chargeable at this point. But of course it's not full rollover, it's partial rollover. And where there is partial rollover, then of course we will limit the rollover relief. The way we did it was very simple. The rollover relief is in fact it's in fact not now what we immediately compute. What we compute is the amount of the gain that will remain chargeable following rollover. Now that is based on two simple numbers that we know. We sold for 34,000 and we reinvested 30,000. So you put 30,000 back into a replacement asset out of the 34,000 that you received. Therefore you have retained net cash of 4,000. There is therefore no reason why that £4,000 worth of this gain should be deferred. You've got the cash in your corporate pocket, that therefore will remain chargeable. So if you now know what remains chargeable, which we do, just take from the proceeds the amount you reinvested, and that then will give you as a balancing figure your rollover relief. The gain before relief was 6,469. The gain that remains after relief is 4,000. So the rollover relief, as we said, a balancing figure of £2,469, and thus we have the chargeable gain arising there. Now again, take a moment to look at that calculation of £4,000 and make sure that you're happy with it. In terms then of dealing with the replacement asset, you know that how rollover works. That rollover relief is a deferral, it's not an exemption. And we roll over that gain, that a deferred gain, we roll it over against the base cost of the newly acquired asset. Well, the newly acquired asset we know actually cost £30,000, against which we now have rollover relief to deduct of 2,469. So the base cost of that replacement for purposes of a future disposal of that asset would be the cost of 30,000 minus the rollover relief of 2,469. Now put that calculation together. When done, then you can check out the answer again in the back, and after you've reviewed through and happy with all of these notes in these sections, you can then attempt the practice questions mentioned here, 26 and 27 and 31. Remembering that if you are dealing with any of these areas so far as individuals are concerned, individuals may damage assets, may lose them, have them destroyed, then the only difference in terms of the rules is there's no indexation allowance for individuals. Individuals, of course, do not get indexation allowance. That is for companies. What an individual gets in relation to their annual gains each tax year is an annual exempt amount. Companies don't get an annual exempt amount. If a company here makes £1 of a gain, then it will be fully chargeable there, subject to offsetting any losses against it. But companies don't get AEA's annual exempt amounts there. They're taxable on every £1 of net gains made in the accounting period. Individuals don't get indexation allowance, but they do get AEA. So it's a slight win there for individuals with AEA. It's then a slight win for companies if they've got indexation allowance, but they don't have AEA. Okay, revise through those rules, practice those questions, and then come back and join us, as it were, for the last of the chapters in relation to our capital gains for companies, where what we'll be doing is based on what you have just done, I hope, prior to doing that example. That's revising through the rollover relief that we saw back in chapter 14, our CGT chapter 14. And for that you need to look at what are the qualifying assets for rollover. How do you deal with full rollover, i.e. you reinvest all the proceeds? How you deal with, as we've just seen, partial rollover. How you deal with the situation where the qualifying business asset that you have now purchased, which would have otherwise become the object of that rollover relief claim, what happens is that you buy instead a depreciating asset. Remind yourself of what they are and what the effect is in terms of any deferred gain. It's not now rollover, but what we referred to as a holdover relief that effectively applies. All of that, please, I need you to do before coming back and joining us again to deal with Chapter 21.